Hi, my name is Niklas Nihtilä, and my project is on the impact of regulation changes and interest rates on private company acquisitions. This research is a part of a larger project that myself and other students have worked on with Rick Haskell from the finance faculty. The larger project looks at how regulation changes and increased capital availability has affected the IPO market and the private equity market in the US. The focus of this particular study is a bit more different. I look at how different regulation pieces and the interest rate environment has affected private company acquisitions in the US. To start off, I'll briefly go over some of the financial concepts that are vital to understand the study. One term that will be used extensively in this presentation is MRIC price, or the market value of invested capital. Simply put, this represents the monetary value paid for the entirety of a company. When referencing the interest rate environment, in very broad terms, I mean the cost of borrowing money at a point in time. This, of course, varies based on multiple different factors, and I'll go more into that on the interest rate used in the study later on. The dataset has transactions ranging from 1999 to 2018, and thus we're focusing on regulations that have been enacted during that time period and which we believe could have affected the private acquisition market. The regulations we focus on are the following: Regulation Fair Disclosure, Sarbanes-Oxley Act, Global Analyst Research Settlement, and Jumpstart Our Business Startups Act. To give you a better understanding of these regulations, I'll briefly go over the main points of each piece. Regulation FD was enacted in 2000. It focuses on the public market, and it states that any material information of a publicly traded company must be disclosed to the entirety of the public. The effect of Regulation MD to the private market is disputable. Unlike some others we're looking at, it does not incur any additional cost to the public companies, but it does open up the companies to liability exposure. So it is unlikely that it had a major impact on the private acquisition market. SOX was enacted in 2002. The legislation impacts only public companies through increasing the cost of staying public. The legislation focuses on increased corporate oversight and strengthened internal control. The legislation's impact is the heaviest on IPOs, which lowered significantly, and due to this, we believe that companies remained private longer and investors began favoring other exit strategies, such as acquisitions. The global settlement took effect in 2003. It focuses on public companies as well and affects the price of an IPO. The main point of the settlement is the division of analyst research and investment banking activities among Wall Street firms, which is said to have increased the cost of securing analyst research for IPOs. The effect on private acquisitions is through the impact on IPOs. As the price of an IPO is increased, companies and investors are more prone to look at other exit strategies, such as acquisitions. However, this will only affect companies at a certain stage, and we expect there to be minimal impact on the overall acquisition market. The Jobs Act was enacted in 2015. The legislation piece focuses on easing the IPO process for smaller companies through easing the disclosure process and allowing the companies to test the waters before an IPO. In addition, the Jobs Act eased the access for capital for smaller companies through greater access to crowdfunding and expanding the number of companies that can offer stock without going through the SEC. We believe easier access to capital for smaller companies could have an impact on acquisitions. However, lower IPO costs would shift the other way, as acquisition targets have smaller barrier to enter the public markets. The other aspect of the study is the interest rate environment. For this research, we are using the federal funds rate, which will be referred to as FFR for the rest of this presentation. FFR is the main tool that the Federal Reserve uses to impact the interest rate environment. It is the base rate at which commercial banks loan overnight deposits to each other to meet the required percentage of the deposits in an account at the Federal Reserve Bank. The reason why we use this in the study is due to its impact over the overall credit environment, as it indirectly affects other borrowing costs. Below, we can see the movement in the rate over time. It follows largely the overall macroeconomic conditions. The interest rate is usually lowered in a recession to stimulate the economy and increased in high growth periods. These two graphs visualize the acquisition trends seen in the dataset used for this study. The graph on the left shows the number of acquisitions per month, and the graph on the right shows the total acquisition value per month. To start off, we see a decrease in the early 2000s as the dot-com bubble burst. Following the burst, we see a long period of high growth as the economy was booming until the financial crisis of 2008. Before the crisis, we see a record number of transactions as well as a large number of large transactions. The financial crisis is also well recorded in the data, with a sharp drop in both prices and numbers. And finally, after the financial crisis, we see slower growth in the number of transactions during the stagnation period. The main point we can realize from these graphs is that they move similar to the overall macroeconomic trends. We see growth when the economy is expanding and sharp decreases in recessions. In this analysis, we try to predict the MVIC price based on different explanatory variables, of which we are interested in the interest rate and regulations. To start off, we begin to look at the distributions of the MVIC prices. The largest number of transactions are relatively small, but there are multiple transactions in the billions. Due to large differences in the prices, the distribution is highly skewed to the right. To address this issue, we can apply a logarithmic transformation to reduce the skewedness. The transformed distribution can be seen on the right. Here we have 4 box plots representing the distribution of the transformed MVIC price before and after each regulation was enacted. These plots help us see if any of these regulations seem to have made a difference. The largest difference seems to be done by Regulation FD, which is odd as the regulation itself should have minimal impact. However, a key thing to keep in mind is that all these regulations represent only one day, which for Regulation FD was October 23rd, 2000. The issue in this case is that it has limited data before the regulation and captures all the transactions after the regulation. Global Settlement and SOX have similar distributions as Reg FD, which makes sense due to the small time difference between the three. Lastly, for jobs, the distribution seems very similar both before and after, thus it seems like it made a minimal or no impact on the MVIC prices. The second portion that we're interested in is the relationship with the MVIC price and the FFR. Here we have a scatter plot to visualize this. Based on this plot, there seems to be little or no relationship between the two variables. The distribution in MVIC price seems to be spread out evenly throughout different rates. The only main thing we see is the large number of transactions when FFR was close to 0%, which is mainly due to the lengthened period when the rate was kept low after the financial crisis. As the dataset is very large and contains a large variety of different transactions over a long period of time, there is some things we need to take into account. To capture the vast variability in the sizes of companies, the models also include a net sales variable, which corresponds to the company's last year's sales. This allows for better comparison regardless of the company's sizes. As with MVIC price, the net sales is also highly skewed, so a log transformation was used on the variable as well. On the top right, we can see a plot that shows the strong relationship with the sales and price variables. Another thing to keep in mind is inflation. Due to the dataset spanning 20 years, the model also has a CPI or Consumer Price Index variable inserted. The variable's main purpose is to take inflation over the 20-year time period into account, so that we're essentially comparing real dollar values. So to assess the impact of these variables to acquisition prices, I looked at 3 different models. A simple linear regression model, which essentially uses the explanatory variables to predict the outcome of a response variable. The MLR tries to model a linear relationship between these explanatory variables and the response variables. It also allows us to look at the impact of a single variable if all others are kept constant, which is key for this study. I also looked at lasso regression and a decision tree, but both had some issues specific to the dataset, so I will use the results from the multiple linear regression model to assess the research question. The main results we're interested in are the coefficients for the regulation variables and the interest rate in addition to the significance of each of the variables, and due to the time limit, I will only focus on these variables. As I used a log transformation for the response variable, the interpretation of the coefficients changes. Instead of the coefficient estimate, we care about the percentage change in the second column. We'll begin by looking at the FFR. We can interpret the results as if everything else remains constant. A 1 unit increase in the federal funds rate will result in a 2.9% increase in the MVIC price. Similarly, for the regulation pieces, if everything else remains constant, regulation FD resulted in a 44.54 decrease in the MVIC price. SOX resulted in a 10.53 decrease in MVIC price. Global settlement resulted in a 15.76% increase, and Jobs Act resulted in a 5.17% decrease. All variables seem to be significant with p-values below 0.05, which is a significance threshold, although jobs and SOX are barely below the limit. On a quick glance, all the results seem to be counterintuitive. All regulation pieces that increase the cost of being public actually seem to decrease the acquisition prices, with the exception of the global settlement. So as the results are quite unexpected, here are some possible issues with the study. The main issue is that all variables used are tied to macroeconomic trends. As seen before, the transaction prices and numbers follow closely the macroeconomic conditions. However, in addition to the response variable, the explanatory variables are also tied to the overall economic conditions. Regulations are usually enacted as a response for a crisis or some macroeconomic event. For example, SOX was enacted as a response to a major financial scandal of public companies. Another issue with the regulation variables is that there's simply one point in time, and in this study, we look at the prices before and after that point. Even though a regulation piece might have an impact on the prices, it is more likely that we're seeing the difference before and after that point in time, which are probably affected by multiple other factors and not only the regulation piece. So the coefficient result doesn't speak fully to the direct impact of the regulation, but rather the overall change in the market before and after the regulation. The interest rate is similarly tied. Even though theoretically speaking, a lower interest rate environment should translate to higher prices in terms of company valuation, we see an opposite relationship in the data. This might be due to many factors, but I believe a major contributor is that the federal funds rate acts as a response for macroeconomic trends. When you have high growth in the economy, like between 2003 and 2008, the Federal Reserve is more inclined to increase the rate to have room to decrease if a crisis would occur and regulate the inflation. Similarly, in recessions, the Federal Reserve is more likely to decrease the rate to stimulate the economy. This in turn corresponds to a positive correlation between acquisition prices and the FFR, which is what we're seeing in the results of the study. So in conclusion, the results of this study seem to be inconclusive. They seem to be contrary to what was expected, which is most likely due to the issue that all of these variables tend to be tied to the overall macroeconomic environment. Even though statistically speaking, we see significant impact from these variables, there doesn't seem to be any actual causal relationship, but rather